Think about two people you probably know. One of them checks their portfolio every morning, chasing the next Nvidia, the next Tesla, the stock that's going to 10x and make them rich. The other one owns boring companies, utilities, a few banks, a dividend that lands in their account every single quarter like clockwork. Same starting money, same years invested, wildly different endings. Here's the thing. Most people pick a side before they ever look at the numbers. They hear, dividends are the only safe way to build wealth, or they hear, dividends are for old people, growth is where the real money is. Both of them are wrong, and both of them are right. Let's break this down with actual math. So here's the question I want to answer today. Dividend stocks versus growth stocks. Which one actually builds more wealth over your lifetime? Not which one feels better. Not which one your uncle swears by. The math. Here's what most people miss. When you say dividend stocks, you're really talking about companies that hand you cash every quarter. When you say growth stocks, you're talking about companies that keep the money and pour it back into getting bigger. One gives you cash in hand. The other gives you a bigger company on paper. And here's where the confusion starts. Because people treat these like they're completely different universes. Like you're either a dividend person or a growth person. That's a false choice. Most great companies are both. But let's run the real comparison, because the difference shows up in one place. What happens to your money over 20, 30 years? Let's set up the experiment. Two investors, same $10,000, same 25 years, same everything. Marcus puts his money in a broad mix of dividend-paying stocks. He reinvests every dividend, every single one. Sarah puts her money in growth stocks, no dividends. She's betting the companies get bigger and the stock price climbs. Now, here's where people get the story wrong. They assume the growth investor wins because growth stocks grow faster. And over some stretches, she does. But here's the thing. The dividend investor isn't just getting growth. They're getting growth plus a cash machine that keeps feeding the portfolio, especially when they reinvest. Ask yourself this right now. Would you rather own a company that grows 8% a year and gives you nothing back, or one that grows 6% a year and pays you 3% on top that you reinvest? The second one compounds in a way most people never calculate, because that reinvested dividend buys more shares. Those shares pay more dividends. Those dividends buy more shares. That's the machine. Now, I'm not going to sell you a fantasy. If dividend investing was strictly better, everyone would do it, and nobody would ever own a growth stock. Here's where the dividend story gets uncomfortable. When growth companies work, when they actually grow, they can outrun dividend payers for long stretches. Think about the tech boom. The companies that multiplied your money fastest weren't paying you 3% a year. They were growing 20% a year and paying nothing. Not theory. Look at the actual numbers over the last decade plus. The broad, growth-heavy index beat the dividend-heavy index over that window. So why do people still swear by dividends? Because of the math nobody talks about, the behavioral math. Here's the thing the numbers don't capture. The dividend investor gets paid to stay. When the market crashes 30%, and it will, multiple times in your investing life, the growth investor stares at a red portfolio and panics. They sell at the bottom. They lock in the loss. That's how people actually lose money, by the way, not by picking bad stocks, by selling good ones at the worst possible moment. The dividend investor? Their dividend still lands, every quarter. During the crash, that check feels like proof the system still works, so they hold. And when they hold through the crash, they get the recovery. This is not theory. The people who built real wealth over 30 years mostly didn't do it by being brilliant stock pickers. They did it by not quitting. Dividends are the psychological anchor that keeps you in the game. Go to your brokerage app right now. Look at your dividend history. Then look at your reaction during last year's dip. Which one kept you calm? Before we get to the verdict and the one strategy that actually matters, if this kind of no-jargon, real numbers breakdown is landing with you, hit subscribe. New videos every week, breaking down how everyday people actually build wealth, not theory. Stuff you can do today. We'll see you there. Now back to the math. Here's where most dividends versus growth videos go wrong. They forget taxes. And taxes can flip the whole answer. This is the part almost nobody tells you. Dividends are taxed in the year you receive them. Growth, as long as you hold, isn't. You only pay tax on growth when you sell.
What does that mean?
If you're holding dividend stocks in a taxable account, you're paying tax every year on that cash. That drag compounds, year after year after year, a little bit leaking out. The growth investor, in that same taxable account, pays nothing until they sell, and even then, often at the long-term capital gains rate. But here's the flip side. If you put dividend stocks in a tax-advantaged account, a Roth IRA, a 401k, the tax problem mostly disappears. The dividends compound tax-free. And then dividend investing gets a whole lot more attractive. Ask yourself this right now. Where are your dividend stocks living? Because that answer matters more than which stock you picked. So which is it? Dividend or growth? Here's the honest answer, and it's going to annoy some people. It depends, but not the way the internet says. The internet says, young people should go all growth, old people should go all dividends. That's a rough shortcut, but it's not the real reason the math shifts. The real reason is cash flow. When you're accumulating, building the pile, you don't need cash in hand. So growth, or growth heavy, can work because you're not relying on the company to pay you. You're riding the compounding. When you're in or near retirement, you need income. You're not adding money anymore, you're taking it out. That's where dividend stocks earn their keep. Steady, growing cash flow you don't have to sell shares to get. Here's the thing. The single best strategy isn't dividend or growth. It's a dividend-paying growth company. It's owning companies that grow and pay. That's the wealth builder that wins in the long run, in the accounts that matter. Let's bring this together. If you want the math on your side, here's what you do. Don't pick dividend or growth. Own both inside the right accounts. Buy a broad index fund that gives you the growth of the whole market. Add a dividend ETF for the cash flow and the psychological anchor. Keep the dividend holdings in your tax-advantaged accounts so the taxes don't eat the yield. Reinvest every dividend while you're still building. Small, consistent, patient. That's it. Not complicated, just uncomfortable. Because it means you do nothing for a long time, and that feels wrong. But the wealth builders are the boring investors. Set it, automate it, leave it alone. Let me tell you what this actually looks like in real life. The dividend investor and the growth investor both start with $10,000. Over 25 years with disciplined investing, both do well. But the one who wins the quietest is the one who reinvests their dividends and stays through the crashes, because they get the growth of the market and the compounding of the cash. Meanwhile, the person who chased the next big growth stock? Some of them got rich. Most of them, the ones who panicked, the ones who sold low, the ones who hopped from stock to stock, ended up with a lot less than they should have. Not theory. That's how the real distribution of outcomes lands. The market rewards patience. It punishes panic. Dividends are just the cleanest way to make patience pay you while you wait. So the answer to which builds more wealth is this, the one you can actually stick with. For most people, that's the one that pays them to stay. Here's your one move. Open your brokerage account. Look at what you own. If it's all one style, all growth or all dividend, you're probably missing the other half of the math. Balance it out. Put the dividends in the right account and reinvest. If this gave you a clear starting point, hit subscribe. Real, actionable money breakdowns, not theory, stuff you can do today. New videos every week. We'll see you there.